Stocks are the most common type of security, with more than 65,000 stocks available today. Preferred stock. In most cases, when people talk about stock, they're referring to common stock. The majority of all stock sold is issued in this form. Common stockholders are owners who can vote on stock splits, company mergers, but they don't get to vote on the payment of cash or stock dividends. Preferred stocks are similar to bonds in structure, but they trade on stock exchange like common stocks. Preferred stock is called this because it has a preference over common stock with respect to dividends and if the company has to liquidate its assets due to bankruptcy. However, unlike common stockholders, preferred stockholders don't get a vote. In today's video, we're going to discuss stocks and stock strategies. Hello, and welcome to Project Dividend, where we help you navigate the journey of becoming a well-informed and knowledgeable investor. Along the way, we encourage you to interact with us through your questions and comments. And if you have not done so before, please subscribe, like, and share this video. The content is not intended to be financial advice. Seek a duly licensed professional for your financial advice. Now that we have that out of the way, let's get started. Let's go. How do stocks work? Well, as a stock investor, there are two basic ways that you can make money. The first is capital gains. If you sell your shares for more than you paid for them, you keep the difference. This is referred to as a capital gain. Conversely, if you sell your shares for less than you paid for them, this is called a capital loss. Dividends are a little piece of the company's profits, typically paid quarterly. Companies don't have to pay dividends to their shareholders, but many times they do. It is important to note even companies that have historically paid a dividend can stop at any time. Stocks typically fall into three investment categories: growth and income, growth, and then aggressive. The growth and income stocks are large cap companies as well as REITs and utilities. A REIT is a real estate investment trust, and a utility is the electricity, natural gas, and water stocks. We'll discuss those in another video. The growth stocks, these are small and mid-cap companies excluding REITs and utilities. And then finally, aggressive. The aggressive stocks are micro-cap companies with share prices below $4, research restricted stocks, and emerging market stocks. All investing strategies have one goal in common: maximizing returns while minimizing risk. While there are a lot of ways to do this, here are some of the most common investing strategies for stocks. Strategy 1 is value investing. This is an investment strategy that involves picking stocks that appear to be trading for far less than their intrinsic or book value. The basic idea is straightforward. If you know the true value of something, you can save a lot of money when you buy it on sale. Generally speaking, value investing requires investors to remain in it for the long term and to apply effort and research in their stock selection. The second strategy is growth investing. Rather than look for low-cost deals like value investors, growth investors look for investments that offer strong upside potential when it comes to the future earnings of the stocks. They typically invest in growth stocks, which are young or small companies poised to expand, expecting to profit by a rise in their stock price. However, such companies are untried and thus often pose a fairly high risk. Investors who follow this strategy should be watchful of executive teams and news about the economy. The third strategy is income investing. Here, the focus is on dividend-paying stocks that can be counted on as a source of money requiring little, if any, extra work or input from the investor. These portfolios generally contain safe, blue-chip stocks with conservative balance sheets and a history of maintaining or increasing dividends per share, even during the rough economic times. The upside to this strategy is you get a generally reliable additional source of income, albeit modest. The downside, you don't get the benefit of the compounding interest because earned income is paid out instead of reinvested. The fourth strategy is momentum investing. Like the name implies, momentum investors ride the waves, capitalizing on the continuance of an existing market trend. This usually involves a strict set of rules based on technical indicators that dictate when you should get into and out of the market for certain stocks. Because this strategy attempts to capitalize on market volatility, momentum investing involves a higher degree of volatility than most other market strategies. Companies that we believe can produce both current dividends and long-term dividend growth offer greater consistency and less volatility than lower quality non-dividend paying stocks. The S&P 500, which is Standard & Poor's, they offer rankings for individual stocks using a system of A through D. The ratings are based primarily on the consistency of a company's earnings and dividend growth during the past 10 years. We believe higher quality companies, B+ and higher, are usually able to generate more consistent earnings and dividend growth. Diversification is a strategy to help make sure your investments aren't concentrated in a certain type or area. By spreading your money among many different sectors, you can help reduce your risk. One of the keys to successful investing is learning how to balance your comfort level with risk against your time horizon. Quality and diversification work only if you hold your investments through both good and bad markets. Of course, even quality stocks can go down if the market drops, which may cause you to second guess your strategy, but don't. Remember why you're investing. Don't lose sight of the importance of time. Focus on the long term and remain disciplined during the short-term market volatility. Here are 2 ways that you can put time on your side besides holding on to these stocks themselves. The first one is to invest systematically. Try to invest regularly when you have money available. Don't wait for the perfect time to put money in the stock market. This strategy allows you to buy more shares when prices are lower and fewer shares when prices are higher. And it's the best way to buy low. The second way is to reinvest your dividends. If you don't need the income, reinvest your dividends into the same stock or into a different stock, whichever is appropriate. This can help build up the number of shares that you own over a period of time. As promised, I said I would release all of these dividend aristocrats, and I would do 5 at a time. And if we can recap, these are the first 15. American States Water, Dover Corporation, Northwest Natural Holding, Genuine Parts, Emerson Electric, Procter & Gamble, Parker Hannifin, 3M, Cincinnati Financial, Coca-Cola, Colgate-Palmolive, Johnson & Johnson, Lowe's, Lancaster Colony, and Nordson. This is the first 15. The next 5 is American States Water, Dover Corporation, Northwest Natural Holding, Genuine Parts, and Emerson Electric. So there we have it, 5 more to add to our list until we get to the 64. Okay, so don't forget to subscribe so that you won't miss out on any of the upcoming aristocrats. Well, that just about does it for this video. Until next time, Hey, Dividend! I've got my eye on you.